with every single policy. So you want to make sure whoever did your policy, this is the perfect time to review it. But going back to the conversation about convertibility, right? Sometimes people will sign up with a term policy because sometimes it can be more affordable.
Mhm.
If you do that, it's not necessarily a bad choice, but make sure it is a term policy at the point in time when you want to transition to whole life. So make sure if you do select a term policy, it has a convertible option in there. So when you want to transition to whole life, you can. What are some of the other benefits? You did talk about whole life, but what are some of the other benefits of having a whole life policy?
Well, again, it's wealth building. You can also build tax-free retirement income.
Mhm.
You can also use it as a collateral assignment.
Mhm.
There are numerous uses and advantages of having a permanent policy. And as I mentioned earlier, it would be just like becoming your own bank because the money is there when you need it the most. It is growing with you.
Now, talk about tax free. How is your money growing tax free?
Well, it's actually growing tax deferred, but when you're accessing it, it's tax free because you are using after tax dollars to pay for that policy. So you have already paid taxes on it. So even when it grows to $200,000, you will be able to access all of that money income tax free.
Okay. Now you mentioned something about a collateral assignment. What is a collateral assignment?
Well, let's say for an example that you are just a business owner, or if you are an entrepreneur and you want to go and you see a building, you want to buy that building and go into real estate.
Okay.
Go to the bank, you want to access money, they're going to ask you if you have a way of paying this money back if something happens to you. Well, you can use your policy and collaterally assign that policy to the bank, and they know that if something happens to you when they loan you that money, that the policy will be there to pay that money back if you can't do that. That's one way.
That's leverage. That's leverage. And so again, tonight we're having a conversation about life insurance specifically, and how you can use life insurance and leverage. Mr. Taylor just stated tax-free, how the money can grow tax-free. He also talked about collateral assignment, right? A lot of times when we're trying to build and grow in life and grow our finances, sometimes it's an instrument that we can use called life insurance, but sometimes it's not being used, and it's left on the shelf somewhere. And so that's why we want to start off the top of this year talking about how do you leverage life insurance and how do you use it. Now let's talk about, let's say somebody's in college, they're not married yet, they're single, no kids. Why would a college student want to get a life insurance policy?
Again, we want to use it to build wealth for ourselves, and you want to build tax-free retirement income. Most of the time, folk are using 401ks, 403bs, or those tax qualifying vehicles. The disadvantage to them is that when the money grows and now you want to get a retirement income, you are taxed on every penny that's coming out of there. Whereas if they had used a life insurance policy the exact same way, and now once you retire and you want to take that out as an income, it would be income tax free for you.
So what I'm hearing from you, let's say someone's in college, they're young, maybe they're not in college, maybe they're in trade school, maybe they just started a business after school, right? I mean, after high school, and they're in their 20s. So even if someone is in their 20s, a life insurance product is advantageous for them.
Absolutely. Absolutely. Because again, You can use it as collateral assignment, and you're using it as a wealth building vehicle that once you use it, tax free. You're not paying any taxes.
Now let's shift gears a little bit. Let's talk about business owners, right? Let's say someone is owning a business. What type of life insurance products out there are helpful for business owners? You know, I heard a term called key person insurance. That's just one of the terms that I've heard, but can you talk a little bit about that or any others that come to your mind?
Sure. You can use it. The key person can be a key employee. It can be several key employees, or the key employee can be yourself as well. And again, we would use that as your retirement building vehicle instead of a 401k or these other tax qualifying vehicles. Also with a key person, it would be a valuable way to maintain a key employee, because you will let them know what you are doing for them. And if they are with you for 10 years, 15 years, or even retire from your company, you can then at that point turn that policy over to that individual, and they will have a lot of money that's there, and it's tax free to them.
And so, as a business owner, how would you say you could frame that type of policy? You know, for the key person, is it a traditional policy with a rider, or how does that work?
It would just be a separate policy. You can use it for the employee to let them know that if they stay with you, this is what you would give them. Instead of a 401k plan, it's going to be this type of plan. The difference is that it's going to be tax-free money to that individual instead of a 401k where they would have to pay taxes on.
Okay, got it. Let's talk a little bit about mortgage protection. So plenty homeowners out there, there's plenty individuals that have questions about mortgage protection. What is mortgage protection under a life insurance vehicle?
Mortgage protection is something that would pay off the home if something would happen to you. You don't make it home at night. You want to make sure that the mortgage is paid off and your family would have a roof over their head. Now, we don't want to get mortgage protection confused with the type of mortgage insurance that you're getting at the time of the purchase. Settlement.
Yes, the time of settlement, because it's different.
That's the type that is protecting the lender, but not protecting you.
Because I think a lot of times I've heard, individuals say, well, I already have it, right? At the time of the settlement, like you mentioned, right? Now, how do you engage with those conversations if you're working with a potential client and they say, well, I already have it, and then you're trying to break down the difference between the two? So like, how, even on this show, break down what is the difference between the two?
Well, I would ask them, when did they purchase it? And if they told me they purchased it at the time of settlement, 9 times out of 10, it is not the type of protection that is protecting you.
Okay.
So I would just ask them to take a look at that.
Okay. And so talk about mortgage protection that we sell. How does that protect the person? It's not protecting the lender, it's protecting the person. You said that a couple of times, but what does that really mean, protecting the person?
Well, if you do not make it home at night, as I mentioned, it's protecting your life. And now the beneficiary is not the lender, the beneficiary you would name.
Okay.
And you want to make sure that you have the named beneficiaries so that when they get the money, they have a couple of options now.
Okay.
They can either pay off the home free and clear of all debt, or they will have the money where they can continue to make the mortgage payments, because they may not want to continue to live there because it may bring back memories, and they said, no, I want to get away from here. So when you're naming an individual, it's giving them the options. Whereas if the lender was named, the money would just go automatically to them, and they may be stuck in a place where they don't want to live.
Okay, so the mortgage protection that's done at the time of the settlement, that insurance, if something were to happen to the owners of the property, goes specifically back to the lender.
9 out of 10 times. Yes.
Okay. Now the mortgage protection you're talking about for the homeowner, let's say the main breadwinner, passed, and that mortgage protection money then would go to the surviving spouse?
Yes. And it doesn't have to be just on the main breadwinner.
Okay.
You can have it on the spouse as well.
Okay.
So that if something would happen to either one of you, you would get the money. Or let's just say something would happen to both of you in an accident, then the named beneficiary will now get double the amount.
Okay. All right. So again, for anyone out there that's a homeowner, this is a perfect time for you to check what type of policies do you have in place. Do you have the initial mortgage protection at the time of the settlement? Did you get any supplemental insurance for you as the homeowner? Maybe you don't have a spouse. Maybe it's just you. Maybe you have a child and you want to make sure, something is passed on to your children should you transition. And, so let's say, for example, a person only had the mortgage protection at the time of the settlement. They did not have an additional mortgage protection on the owner, right? Of the what could potentially happen if something occurred?
You can lose your home because of the fact that mortgage amount is still due every 30 days.
Okay.
So
then where did that money go that the lender has under that mortgage protection?
Again, that's protecting the lender in case there was a default on your part.
Default. Okay, I got it.
That's why you want to be very, very careful that you have the correct one.
Okay.
Yeah.
Endowments. Do you ever talk about endowments?
Sometimes we would talk about endowments. I don't know if you're looking for endowments for an institution. That would depend. If your demise occurred, you may have a special charity or something like that that you would leave the endowment for. That's the way that most people would use an endowment, if that's what you're referring to.
Yes, I am. So nonprofit organizations out there, leaders of civic organizations, they have 501c3s. You want your organization to live on, right? When I was looking at Goodwill Industries and I was looking up their financial matrix and how they raise funds, because it is a nonprofit organization, Goodwill Industries. One of the line items that I saw and how they generated money was through endowment. And so I think that's a sign for any of us that we need to put something like that in place. And again, we talked about many movable pieces tonight. We talked about insurance products, how it benefits the family unit. We talked about how it can benefit the child. Why do you call it the equalizer?
Because of the fact that it's a wealth building vehicle, and I can't think of anything else that would grow wealth quicker than that, and we can pass that on. And I had mentioned earlier that we are 8 to 9 times behind the majority community when it comes to accumulating wealth.
You say we're behind 8 to what?
8 to 9 times.
Mhm.
As far